Welcome to The Explainer, where we dig into the data that's really shaping our world. And wow, today, we're looking at a global economy that's basically stretched to its absolute breaking point. We're talking geopolitical shocks, central banks going in completely opposite directions, and a massive shift in things like gold and silver.
All right, let's jump right in. The number of the day, the one that kicks everything off, is this: 8 to 10 million. What is that? That's how many barrels of oil per day are just stuck, stranded. They can't get to market. And the data is clear. This is the biggest supply shock in history, seriously. And it's the trigger for pretty much everything else we're going to talk about today.
So, why is this happening? It all comes down to the Strait of Hormuz being effectively shut down. I mean, think about it. This one little choke point handles a fifth of the entire planet's oil supply. And it's not just slowing down, it's a full-on shutdown.
Okay, look at this. This is where you really see the scale of the paralysis. I mean, the numbers are just wild. Daily ship transits, they've collapsed by more than 80%. And the ships that are brave enough to go through, get this, the data shows over half of them are part of this uninsured, untraceable shadow fleet. The big mainstream shipping companies, they're gone. They've abandoned the route. And no surprise, that sent Brent crude oil rocketing up towards $120 a barrel.
So to stop the entire global economy from just falling off a cliff, right, the International Energy Agency had to step in. They've organized the biggest intervention in their entire 52-year history. We're talking a coordinated release of 400 million barrels of oil from emergency reserves. This is a straight-up Hail Mary to try and keep prices from going into orbit.
And this is the crucial part. This action creates two totally different paths forward, like a fork in the road. The mainstream view, the consensus, is that this huge release does the trick. It caps oil prices below $95 and, buys everyone some time to figure things out diplomatically. But the other view, the contrarian one, it says this is just a tiny band-aid on a massive wound. If this crisis lasts longer than the 90 days of extra oil, then we could see oil blast past $150 a barrel, and that would almost certainly trigger a really bad global recession.
Okay, so you've got this massive energy shock. Let's follow the ripple effects because they're hitting the world's central banks in a huge way. And what we're seeing is this great divide in how they're reacting, and it's basically fracturing the global economy. And this chart just lays it out perfectly. It's a tale of two worlds. On one side, you've got the US Fed. They're keeping interest rates high because they're fighting the stubborn 2.8% inflation, which is being pumped up by this incredible boom in AI investment. Then you look at Europe. The European Central Bank is doing the exact opposite. They're cutting rates. Why? Because their industrial sector is struggling, inflation is way lower at 1.9%, and they're desperate to get things moving again.
So yeah, the data is screaming policy divergence. And before we dig into what this split can mean for the markets, just a quick reminder. Everything we're talking about here is for informational purposes. This isn't investment advice. You should always make your own decisions based on your own situation. Okay, with that said, let's look at the hidden risks here, because that's where things get really interesting.
Right, so most people are expecting a soft landing for the US and for Europe to kind of muddle through, the consensus view. But in an environment this crazy, you have to pay attention to the contrarian risks, the things nobody wants to talk about.
So what are those risks? For the US, the nightmare scenario is that this oil shock forces the Fed to not just keep rates high, but to do emergency rate hikes. That would be the pin that bursts the entire AI investment bubble. And for Europe, they're in a really tough spot. That same oil shock would mean importing a ton of inflation. They'd have to slam the brakes on their rate cuts, and that could push them right into a deep stagflationary crisis. That nasty combo of high prices and a dead economy.
But hey, these tensions aren't just a US and Europe story. Not at all. The data is pointing us to Asia, where we've got two huge powers walking a very, very fine line.
Everyone's laser focused on what the Fed and the ECB are going to do next. But what if the data is telling us that the biggest, most dangerous hidden risk, the thing that could actually trigger a global crisis, is building up somewhere else entirely?
The common wisdom is that China will somehow manage its property crisis and Japan will take its sweet time raising interest rates. But the contrarian take? It points a giant finger right at the Bank of Japan as the #1 global risk. China's problem could lead to a currency war, sure. But Japan's problem, that could lead to a global liquidity crisis.
Okay, so here's the deal. The Bank of Japan is way, way behind on tackling inflation. Now, if this global energy shock forces their hand and they have to do a sudden emergency rate hike, that could set off a bomb called the yen carry trade. For years, investors have borrowed Japanese yen for practically free to buy other assets around the world. If Japanese rates suddenly spike, all those investors have to unwind that trade. They have to sell everything, US stocks, US bonds, you name it, to pay back their yen loans. All that selling would cause borrowing costs to spike everywhere, and you'd have a massive credit crunch, a global liquidity crisis.
So with all this chaos in energy markets and with central banks all over the map, it's really no surprise that people are running for cover in hard assets, right? But here's the kicker. The data shows this isn't just your normal upswing. We're seeing a fundamental structural change in how these assets are valued.
Let's talk about silver first. Seriously, you have to forget everything you thought you knew about it. It's not just a precious metal anymore, something that just moves with interest rates. No way. It's now a critical industrial commodity, a bottleneck even.
And this chart shows you exactly why. Just look at it. The data is clear. Industrial demand for things like solar panels, EVs, and especially AI data centers. It now makes up a whopping 60% of all silver use. 60%. This has created a huge multi-year shortage. We are literally using more silver than we can mine.
And because there's this physical shortage, you're seeing some absolutely wild price targets from the big banks. Sure, you've got JP Morgan at $85, but then look at Bank of America. They're modeling scenarios where the paper market for silver, futures and contracts, completely breaks from reality. And if that happens, they see prices potentially spiking past $300 an ounce. Just incredible.
And it's a similar story with gold. It's in a whole new world. The historic rally we're seeing, it's not being driven by you and me. The data shows the real engine here is a huge structural shift. It's central banks in emerging markets. They are buying gold like crazy, and they don't even care about the price. They're just buying because they want to move their reserves away from the US dollar and other Western assets.
Okay, so let's put it all together. You've got the energy shock, the central banks going opposite ways, the hidden time bomb in Asia, and this mad dash into hard assets. When you mix all that up, you're left with two and only two very different futures for the global economy.
Path number one is the consensus path, the everything's going to be okay path. This is the soft landing, where conflicts get sorted out, inflation chills out, and the S&P 500 cruises to 7,800 on the back of the AI revolution. But then there's the other path, the contagion path. And this is a terrifyingly real possibility where all these separate problems we've talked about crash into each other and drag the entire world into a recession at the same time.
And here's how that domino chain could fall. It's a simple, brutal chain reaction. 1. The Hormuz crisis doesn't get solved. 2. This keeps inflation high and forces the Fed to hike rates. 3. Those higher rates kill the AI investment boom. And 4. The collapse of that AI bubble is the final domino that pushes the entire world into a nasty, synchronized recession.
So that leaves us with one last big question to chew on. In a world that's so clearly split in two, where the data is pointing to these completely opposite futures, is following the crowd, the consensus path, the safe bet, or is it a trap?
Look, the data is painting a really complex picture here. And whether we end up with that soft landing or a full-blown global contagion, understanding all these different forces is absolutely crucial. If you got some value out of this data breakdown, do us a huge favor and subscribe to @NextGenInvestGlobal. Oh, and like and share this explainer. It really helps support the channel. Thanks so much for watching.